Hey everyone, and welcome to This Explainer. I'm so thrilled you're here today because the stock market is doing something absolutely remarkable right now. And surprisingly, most people aren't even paying attention to the one key metric that proves it. Today, we're going to demystify the current market, and we're doing it completely jargon-free. So if you're a beginner investor or honestly just someone who wants a crystal clear understanding of where your money is sitting, you are in the exact right place.
Okay, let's dive straight into this. 16.70. I know, it just looks like a totally random decimal, but it's actually the secret to understanding the entire market psychology right now. This specific number proves that investors at this very moment, they aren't scared. They aren't panicking. They're incredibly confident. We're going to unpack exactly why this mysterious number matters and what it really means for your financial future.
Here's a quick roadmap for how we're going to tackle this today. First, decoding the fear gauge. Second, a historic winning streak. Third, the three forces driving markets. Fourth, what Wall Street thinks. And number 5, the bottom line. All right, section 1, decoding the fear gauge. So that 1670 number, it comes from something called the VIX. Officially, that stands for the CBOE Volatility Index, but if you're new to investing, honestly, just think of the VIX as Wall Street's ultimate fear gauge. Technically speaking, it tracks the price of options on the S&P 500 over the next 30 days. Basically, when investors get nervous, they buy protective options to hedge against a crash, and that makes the VIX spike. When they're feeling calm and secure, the VIX just naturally falls. Let's break this down with something we all get: insurance. Imagine a massive storm is rolling in. Everyone rushes out to buy storm insurance, right? And because everyone is rushing at once, prices skyrocket. But on the flip side, when it's sunny, 75 degrees, and not a cloud in the sky, well, nobody's in a rush to buy storm insurance, so prices stay super low. The stock market works the exact same way. High fear drives up the cost of market insurance, while calm confidence keeps everything nice and cheap. Now, what's really interesting here is how we can use this like a decoder ring for the market's mood. If you see a VIX reading over 30, warning bells should go off. That's high fear, maybe even panic. Between 20 and 30, that's your moderate uncertainty zone. And if it drops under 15, the market might actually be a little too complacent. Like investors are so comfortable, they're ignoring obvious risks. But look at where we are, 16.70. We are sitting right in this perfectly healthy, calm band. Experts actually call this specific zone rational optimism. Which brings us to section 2, a historic winning streak. So what does this rational optimism actually look like in the real world? Well, on May 22nd, the S&P 500 closed at 7,473 points. That is incredibly close to its all-time record high of 7,517, set just a few days prior on May 14th. The market is literally hovering right at its absolute peak. And this isn't some random lucky spike. It's a sustained, powerful uptrend built on solid economic fundamentals. And hey, it is not just the S&P 500 having all the fun. The Dow Jones Industrial Average recently surged nearly 300 points in a single day, shattering that massive psychological 50,000 threshold to hit a brand new record high. This is a huge, huge signal, especially for new investors. Why? Because it proves this rally is broad. We aren't just relying on 2 or 3 megatech companies to pull the whole train. Value stocks, dividend companies, industrial giants, they're all getting in on the action. And all of this broad, durable growth, it's led to a truly incredible milestone, a stunning 9-week streak of consecutive gains. To put that into perspective, you're looking at one of the rarest sustained rallies in modern market history. It's the longest winning streak we've seen since 2023, and it is a massive testament to just how much underlying strength is in the economy right now. Moving right along to section 3, three forces driving markets. Whenever I look at complex market stuff, I love using the rule of 3 just to keep things grounded. There are 3 big forces driving this historic streak: massive corporate earnings, geopolitical calm, and favorable interest rate expectations. Let's peel back the layers on each of these so you can see the engine powering this bull market. First up, earnings. Corporate America absolutely crushed it in the first quarter of 2026. Across the board, S&P 500 companies beat expectations by roughly 20%. That is a blowout performance. Just to show you the sheer scale of this, Micron Technologies just crossed the $1 trillion market cap threshold for the very first time. $1 trillion. And a lot of that is being driven by incredible spending in AI infrastructure. The second force at play is geopolitical calm. We saw oil drop back toward $88 a barrel recently. This drop is heavily tied to progress toward a potential peace arrangement between the US and Iran, which could eventually fully reopen the Strait of Hormuz. For global markets, this headline was a massive sigh of relief. It almost immediately eased those nagging inflationary pressures on energy costs. Which is a perfect segue to force number 3, favorable interest rate expectations. Because inflation is finally showing signs of cooling off, investors are anticipating a much friendlier vibe from the Federal Reserve. When borrowing costs stabilize or even fall, it suddenly gets a whole lot cheaper for companies to grow. That makes holding stocks highly attractive as we push into the second half of 2026.
All right, Section 4. What Wall Street thinks. Let's start with Jamie Dimon, the iconic CEO of JP Morgan Chase. He recently described the market as exuberant but reasonable given current conditions. Now, that is a very deliberate choice of words. Smart money, like Dimon, totally acknowledges that this rally is incredibly strong, but they also recognize that valuations are getting a little bit stretched. It's this careful balance, enjoying the success without getting completely intoxicated by it.
And looking down the road, heavyweight firms like Bank of America and Goldman Sachs have actually set 8,000 as their bullish year-end target for the S&P 500. That implies there's still plenty of room to run. But, and this is a pretty big but, these same firms are telling their clients to start rotating into some profit protection as summer approaches. Historically speaking, summer months can just get a little choppy.
Then, offering a pretty stark contrast, we have legendary investor Warren Buffett. He's out here warning about a quote-unquote gambling mood in the markets. In fact, Berkshire Hathaway has been noticeably sitting on its hands, holding back on deploying its massive pile of cash. And honestly, this is such a crucial lesson for anyone new to investing. Two things can be true at exactly the same time. The market can be on a historic winning streak with strong fundamentals, and extreme caution and patience can still be completely justified.
Finally, Section 5, the bottom line. So, what does this all mean for you? Here is the crucial takeaway. The bull market is real. The fundamentals absolutely support it. But that VIX reading of 16.70 tells us that while near-term volatility is low, this isn't a free ride. It doesn't mean the market is somehow magically immune to a pullback. What it does mean is that current conditions support calm, rational investing. There's literally no reason to make panic-driven decisions right now. Which leaves us with this final thought. Are you investing with rational optimism? Or are you sitting on the sidelines, waiting for a storm that the data says just isn't here yet? The fear gauge is calm, earnings are strong, and the trend is undeniably clear. Take a look at your own mindset, apply what we talked about today, and let that guide you toward confident investing. Thank you so much for joining me for this explainer. Stay focused, and as always, keep learning.